and welcome to another segment of Accounting 101. My name is Dr. Annette Moultrie, and let's see what we have in store for you in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. This is Accounting 101, Chapter 7, Accounting Information System. Accounting Information System, Chapter 7. The learning objectives are 7.1, describe an effective accounting information system. 2, journalize and post sales and cash receipts in a manual accounting information system using special journals and subsidiary ledgers. 3, journalize and post purchases, cash payments, and other transactions in a manual accounting information system using special journals and subsidiary ledgers. And 4, describe how transactions are recorded in a computerized accounting information system. However, this is part 1 of Chapter 7. We will discuss learning objectives 1 and 2. Learning objectives 3 and 4 will be presented in part 2. Learning objective 7.1, describe an effective accounting information system. An accounting information system, or AIS, collects, records, stores, and processes accounting data to produce information that is useful for decision makers. Businesses must have a way to collect and store data for a large number of transactions, and then use the data to produce reports that investors, creditors, and managers can use to make decisions. Here you see Exhibit 7-1. It shows examples of business transactions and activities that are completed when using an accounting information system. For example, business transactions such as sell merchandise inventory. The AIS activities are receipt of customer order, approval of credit sales, check availability of merchandise inventory, shipment of inventory to customer, processing of sales invoice, receipt of customer payment. A business transaction such as payroll, the AIS activities include, but not limited to, approval of new employees, collection of time periods, preparation and payment of payroll, preparation and payment of payroll taxes. An accounting information system must provide adequate controls of the business's assets and data. Internal controls can safeguard a business assets and reduce the likelihood of fraud and errors. An accounting system creates the structure to encourage adherence to management procedures. A compatible system works smoothly with the business's employees and organizational structure. A large company needs a system that can handle multiple branches and track revenues and expenses in all divisions of the business. An accounting system must be flexible. It must be flexible to accommodate changes in business over time. An effective information system provides information that is relevant. In other words, it improves decision-making and reduces uncertainty. The information produced must be useful to the business in achieving its overall goals. An effective accounting information provides control, compatibility, flexibility, relevance, and positive cost-benefit relationship. They can also be expensive. A business, need, a business needs a system that gives the most benefit for the least cost. The business must consider the cost of training employees to use the system and time spent on entering data into the system. The business must invest only in an accounting system in which the benefits received outweigh the cost of the system. Accounting information systems have three basic components: source documents and input devices, two, processing and storage for information, and three, outputs. All data must come from source documents, which provides the evidence and data for accounting transactions. Examples of source documents include purchase invoices, bank checks, and sales invoices. Now, once data have been input into the system, they must be processed. In a manual accounting information system, processing includes journalizing transactions and posting to the accounts. A computerized system, on the other hand, uses software to produce or process transactions. A business's data must be stored. In a manual system, data are contained in paper documents that are often stored in filing cabinets and off-site document warehouses. However, computerized systems now allow businesses to keep data on a main computer called a server, which often allows employees to access information from anywhere in the world. A server is the main computer where data are stored, which can be accessed from many different computers. Outputs. Outputs are the reports used for decision making, including the financial statements. Learning Objective 7.2. Journalize and post sales and cash receipts in a manual accounting information system using special journals and subsidiary ledgers. How are sales and cash receipts recorded in a manual accounting information system? Well, we begin by reviewing how transactions are recorded in a manual accounting information system. You may be wondering why we cover manual accounting information systems when many businesses have computerized systems. Well, there are three main reasons. One, learning a manual system equips you to work with both manual and computerized systems. The accounting is the same regardless of the system. Two, few small businesses have computerized all their accounting. Even companies that use QuickBooks or Sage 50 accounting, two popular entry-level accounting information systems, keep some manual accounting records. And three, learning a manual system helps you master accounting. In a manual system, transactions are classified by type. It is inefficient to record all transactions in the journal entry, so businesses use special journals. A special journal is an accounting journal designed to record one specific type of transaction: sales on account, cash receipts, purchases on account, and cash payments are treated as four separate categories and therefore create the four specific journals. The four specific are special journals are sales journal for sales on account, cash receipts journal for cash receipts, purchases journal for purchases on account, cash payments journal for cash payments. A cash journal is used to record all other transactions, including adjusting entries. The 5 types of transactions, the journal related to each, and the posting abbreviations used in a manual system are summarized here in Exhibit 7-2. Sales on account, the general sales journal. Posting abbreviation is S. Cash receipt, the journal is cash receipts journal. The posting abbreviation is CR, and so forth and so on. In addition to special journals, an accounting information system uses subsidiary ledgers. A subsidiary ledger is a record of accounts that provides supporting details on individual balances, the total of which appears in a general ledger account. The accounts receivable subsidiary ledger is a subsidiary ledger that includes an accounts receivable account for each customer that contains detailed information such as the amount sold, received, and owed. The accounts payable subsidiary ledger is a subsidiary ledger that includes an accounts payable account for each vendor that contains detailed information such as the amount purchased, paid, and owed. Now, don't confuse the terms customer and vendor. Remember that a company sells to customers and purchases from vendors. The accounts receivable subsidiary ledger includes a receivable account for each customer. The customer name and account balance are detailed in the subsidiary ledger. In addition, the subsidiary ledger contains detailed information such as the amount sold, received, and still due for each customer. The accounts receivable account is the general ledger is called a control account. A controlled account is an account whose balance equals the sum of the balances in a group of related accounts in a subsidiary ledger. The total of the accounts in the accounts receivable subsidiary ledger must equal the accounts receivable balance in the general ledger. This is demonstrated in the exhibit that you see here, 7-3. The accounts receivable balance of $4,319 in the general ledger equals the sum of the accounts in the accounts receivable subsidiary ledger. So this $4,319 is equal to the accounts receivable subsidiary ledger, the $935, the $694, the $907 in the accounts receivable, and again in the accounts receivable was $1,783. So these 4 totals will equal what's in the general ledger. To pay debts on time, a company must know how much it owes each supplier. Accounts payable in the general ledger shows only a single total for the amount owed on account. It does not indicate the amount owed to each vendor. Companies keep an accounts payable subsidiary ledger that is similar to the accounts receivable subsidiary ledger. The accounts payable subsidiary ledger List vendors in alphabetical order, along with the amounts paid to the vendors and the remaining amounts owed to them. The total of the individual balances in the subsidiary ledger equals the accounts payable or the control account balance in the general ledger. Most merchandisers sell inventory on account. These credit sales are entered in a sales journal. The sales journal is used when recording the sale of merchandise inventory on account. A sales journal is a special journal used to record credit sales. The sale of merchandise inventory for cash is not recorded in the sales journal. Instead, it is recorded in the cash receipts journal. In addition, credit sales of assets other than merchandise inventory occur infrequently and are not recorded in the sales journal. They are recorded in the general journal. Here in Exhibit 7-4, it illustrates a sales journal. Panel A and the related posting to the ledgers, Panel B. Here you see in Panel A, the sales journal. When a business completes a sale, the accountant enters the date, the invoice number, the customer name, and the transaction amount. Here in Panel B is posting to the ledgers. Here is the accounts receivable subsidiary and individual accounts receivable are posted daily. And here you see the general ledger. Totals are posted at the end of each month. Totals are posted at the end of the month. Consider the first transaction in Panel A of Exhibit 7-4. On November 2nd, the business sold merchandise inventory on account to Maria Galvez for $935 with a cost of $505. The invoice number is 422. In Chapter F5, Chapter 5, this transaction was recorded in the journal. So on November 2nd, accounts receivable was debited for $935 and sales revenue was credited. November 2nd, cost of goods sold, $505 was debited and merchandise inventory was credited for the same amount. When a business uses special journals, instead of recording this transaction in the general journal, the business records the transaction in the sales journal. All of the information related to the sale appears on a single line in the sales journal. The entry records the sales revenue and associated accounts receivable by entering the amount of the sale, the $935, in the accounts receivable debit sales revenue credit column. The entry also records the expense of the sale and the reduction of the merchandise inventory by recording the cost of the sale, $505, in the cost of goods sold debit merchandise inventory credit column. By using a sales journal, the recording of the sale is streamlined, thus saving a significant amount of time. Now notice here that the journal has a single column to debit accounts receivable and credit sales. Therefore, by the very nature of this special journal, the amount for each transaction is listed only once. The same is true for the cost of goods sold and merchandise inventory accounts. All businesses have lots of cash transactions, and a cash receipt journal therefore comes in handy. The cash receipts journal is a special journal used to record cash receipts. Every transaction in this journal is a cash receipt. Here you see an example of a cash receipt journal. The cash receipt journal includes a column for debits to cash. The next column is for debits to sales discounts. The main sources of cash are collections on account and cash sales. Collections on account are recorded in the accounts receivable credit column and the cash debit column. Cash sales are recorded in the sales revenue credit column, the cash debit column, and the cost of goods sold debit column. Merchandise inventory is in the credit column. The cash receipts journal also has other accounts credit column that is used to record miscellaneous cash receipts transactions. Here in panel B, it shows how the transactions from the cash receipt journals are posted to various accounts. Here to your left are the accounts receivable subsidiary ledgers, and to the right is the general ledger. In Exhibit 7-5, the first cash receipt occurred on November 6th and was a cash sale of $517. Cost of goods sold, $290. Here in this slide, it shows the journal entry if the transaction had been recorded in the general journal. By recording the transaction in the cash receipts journal instead, the entries can be recorded on one line. Observe the debit to cash and the credit to sales revenue of $517. Notice the debit to cost of goods sold and the credit to merchandise inventory with $290 for the cost of the merchandise sold. On November 11th, the business borrowed $1,000 from First Bank. Here in this slide, it shows the journal entry if the transaction had been recorded in the general journal. By recording it in the cash receipts journal instead, the accountant would record the $1,000 in the cash debit column. The other account credit column is used for the notes payable credit because there is no specific credit column for borrowings. So for this transaction, the account title, Notes Payable, First Bank, is entered in the account credited column. The other accounts credit column is used when a transaction involves a credit entry that is not listed in the headings or the columns of the cash receipts journal. Amounts from the cash receipts journal are posted to the accounts receivable subsidiary ledger daily. The postings are credits. After posting, the accountant enters a check mark in the posting reference column of the cash receipts journal and shows the posting reference in the subsidiary ledger. At the end of the month, each column in the cash receipt journal is totaled. The equality of the debits and credits is verified by comparing the sum of all debit columns to the sum of all credit columns. All columns except for the other accounts credit column are posted in the total to the general ledger. The column total for other accounts credit is not posted. Instead, these credits are posted individually. As with the sales journal, entries in the cash receipts journal are posted daily to the accounts receivable subsidiary ledger and monthly to the general ledger. After posting, the sum of the individual ending balances in the accounts receivable subsidiary ledger equals the ending balance of the accounts receivable in the general ledger. And here you see the accounts receivable debit balance, the $2,690 is equal to the subsidiary ledger accounts receivable account. So this is part 1 of chapter 7. This is the end of part 1 of chapter 7. We discussed in this video learning objectives 1 and 2. Thank you for watching. And please, if you haven't already, please click the subscribe button below.